Hey folks, welcome back to the channel. How is everyone doing today? Fire off with the questions again today. We are going to be talking about a lot of things going on in the economy right now, but particularly what the Fed is doing. And I want to start off by saying that none of you who watch my channel regularly should have been surprised at all by what the Federal Reserve, the chairman of the Federal Reserve said yesterday or by their actions. I've been calling a 75 basis point rise since the last one was made. I'm calling a 50 basis point rise at the next meeting. And I think that is really just a conciliatory action to soothe markets to a degree. And I think that statistically, it's not really going to matter that much in the long run. But I discussed this in my Patreon group just a little bit. I kind of posted a prediction in there saying that, hey, the Fed's going to raise the interest rates by 75 basis points, but they're not going to do anything going forward about a Fed pivot. They're not really worried about throwing the economy into recession. Sure, that's not the ideal situation, where you reduce the amount of money in the system, and that reduces liquidity, that actually leads to a recession. Certainly not the ideal situation, but that's far less of a concern to the Federal Reserve than a long-term period of baked-in inflation. They are willing to sacrifice the stock market and willing to sacrifice your job in order to control inflation. And I say that with a straight face because this is just a sad fact of the matter. We're not talking about morality here. We're just talking about the decisions. The Fed stated that controlling inflation is going to hurt. It's going to hurt somebody. It's probably going to hurt somebody listening to this broadcast. So, good news on the front when it comes to inflation, of course, is the fact that we basically finally forced the Bank of England to follow suit. And it looks like the European Central Bank is going to follow suit as well. So as TEL 666999 says, from the UK, and the 75 basis point percent rate was expected, Bank of England predicts for the UK a long 2-year recession. So typically, if you're a European watcher, typically recessions in Europe last longer than they do in the US. That has been true ever since World War II. I have my opinions on why that is. These are not opinions that I could actually back up with data. I feel like it has to do with overregulation. So I've tried to open up a number of businesses in Europe, and the cost of regulation makes entrepreneurship a bit more expensive there, including in businesses that, and in fact, there's one business that I'm actually glad I never started because it would have gotten crushed by Amazon. But the permitting process was outrageous for that business. And it basically convinced me that profitability was so far along out there that I went ahead and put my money back in the United States. So um, wanted to take a little bit of a look at Barron's today. And when you look at the headlines in Barron's, a lot of times the headlines that are in Barron's are usually not all that reflective of the most important news in the economy. A lot of times it's just things that I'm interested in that I find. But today in particular, there's a lot of things in here that are very, very impactful. And this is the big one. The market's new big problem, shrinking profit margins. Okay. So even if we are not officially in a recession where we see 2 consecutive quarters of declining GDP, which now, according to the academic definition, we'd be out of that since this last quarter we had economic growth or GDP growth of 2.6%. We may still face something called a earnings recession, where the economy is growing as a whole, but because of a strengthening U.S. dollar overseas and because of inflation here and reduced purchasing power, what we see is an earnings recession, where companies still reporting bottom line revenue that looks really good, but costs, end up getting very high, and perhaps overseas sales decline a little bit. And what we see is a decline in profitability for companies. And there are a number of different companies that hold significant operations overseas. Like Caterpillar is the one that really comes in mind. Like, I really expect them to struggle next year, especially with all that's going on with China. I don't think that you guys in the general public understand the shot across the bow that the semiconductor sanctions were that was just fired a couple of weeks ago. This is not necessarily going to cripple the Chinese economy outright today, but it's going to cost them an enormous amount of time and money to replace the chips that they're getting from Taiwan. And from right now, it looks like based on U.S. sanctions, it's going to be very difficult for the Taiwanese to actually do business with China. So, in fact, they've halted all business right now, ostensibly to determine whether or not they're going to violate sanctions by the things that they're selling. But the bottom line is that there's a number of different technologies and a whole world of expertise that China is going to have to work on developing in-house now, and that is going to take time. It also, unfortunately, is going to affect a number of other things. And actually, I want to talk to you about this because you made a number of comments on Xpeng, and I remember what your cost is. It's up there. You're down a lot on Xpeng right now. I'm down a lot on Xpeng right now. I'm less worried about the 5,100 cars this month. It's not that they weren't able to produce more than 10,000 cars each month. It's that they probably weren't able to move them. And with Tesla actually lowering prices right now, that might get worse. So Tesla price cuts are resulting in cancellations for China EV brands. And what we're really talking about is the Model 3 and the Model Y in China. And that is the Xpeng P7, and that is two different models of of Neo that are sold out there, and of course the ET7, which is kind of a Model 3 competitor. That could really be more of a Model S competitor. But Tesla's output at Gigafactory Shanghai was actually down in the month of September, but it looks like they're finally reacting to some of the demand side of their business. They've cut prices just in China at this point, and it looks like the Chinese EV brand order backlog have suffered significant cancellations. Now, I don't know if that's because of a rising crisis in the Chinese economy that's not necessarily being published here in the U.S., or if it is because of the price cuts to China-made Teslas right now. In other news, Tesla appears this could be viewed more negatively than it should be. All right. So Tesla is, California's home to the first Tesla factory. There's a lot of vehicles that are produced here. You also have the highest proportion of Teslas on the road in this state, probably in Southern California alone, just concentrated in Los Angeles and San Diego. You probably have a higher concentration of EVs anywhere outside of China, right? So it makes sense that market saturation with Teslas is going to happen somewhere first. It may be beginning to happen here. It also may mean that the share of zero emission vehicles in California, which has now reached 18%, right? So let's see here. So California is the biggest U.S. state for zero emission vehicles, which also includes hydrogen fuel cell and plug-in hybrid electric vehicles, and accounts for 18% of new car sales in California this year. So plug-in hybrids, not just regular hybrids, hydrogen fuel cell, which is there's very few of those sold here, although there are like 18 stations, refueling stations just here in San Diego, and electric vehicles. So Tesla's share of that California battery electric vehicle market is shrinking. Now, this is not the warning sign that I think a lot of people think it is, largely because you can't see all of the other vehicles, the battery electric vehicles that are being driven here in the U.S. now. So it's in California. So it's about a 10-mile drive to drop my kids off at school. And unfortunately, there's a ton of traffic because it's Southern California. But I'm counting, and I do this every morning. I count the number of Teslas and I count the number of EVs. And then I keep finding at least once a week, I find a new EV that I've never heard of, or if I've heard of, I've never seen it here. And of course, this is also a test market. So you're seeing that there's just a lot more competition now. The pie is getting larger, and Tesla's proportionate share of that pie is smaller, but not because they're selling fewer vehicles. It's just because that pie is growing faster than their proportionate share is. So, and I do think that that's probably going to change, of course, when we start including the Tesla Semi, we start including the Cybertruck, whenever the hell they decide to start making the Cybertruck. So Tesla sales in California are still increasing. It's just that total battery electric vehicle sales are increasing faster than total battery electric vehicle sales are, or Tesla sales are. And that has everything to do with competition. The VW ID4 is selling fairly well out here. a number of Kia electric vehicles are selling fairly well out here, and that's kind of what's changing here. So if you're looking at markets, and I talk to people particularly in the on the East Coast, right? Not even on the East Coast, but really like Kentucky, Tennessee, Alabama, who just can't envision this battery electric future. And I have to keep reminding them that the future is already here. It's already here. It's already in China. It's already in California. It's already in Europe. Something like over half of all vehicles sold in Norway last year were battery electric vehicles. More than half of all vehicles sold in Iceland, in the Netherlands. I think, well, the Netherlands was a little bit less than half, but in a number of different countries, the proportionate share of battery electric vehicles is more than a third of what's being sold on an annual basis. So this is what's happening right now. Let me see here. So good question. If it puts a foreign company in China has to subsidize China's local brands, why produce in China? But if yeah, yes, absolutely. And that's so what's going on in China right now actually has me a little bit worried about Tesla as well. And I wish they would further diversify their manufacturing base. Like I was hoping that beyond Berlin, they would have already started on perhaps a gigafactory in Indonesia or a terafactory in India or something like that. Largely because I think that geopolitical concerns when it comes to China have become greater. Not the fact that there's an actual real risk of war with China. There really isn't, because um, we could literally park one aircraft carrier in the Indian Ocean and prevent them from getting most of their oil supply from the Middle East, right? So for that reason, there's almost no chance of a war going on there. When I'm talking about geopolitical things, I'm talking about really the risk of them finding a reason to limit Tesla's availability, or finding reasons to limit their ability to produce or something like that. And just to make up a reason like they have in the past, they've forced Tesla to do a few recalls for things that wouldn't be recalled here in the US. And things that may not have existed to begin with. So Redshift says China is still all in on the zero COVID policy also. For all the conspiracies here in the US centered around, the masks are all about control and things like this. And, the vaccine was all about control, and which of course that's all BS. None of the conspiracy theories are usually just 99% BS, 1% maybe 0.1% fact or something. But in general, China's zero COVID policy has been used to legitimize power to a degree of the central government. And we're seeing something emerge in China that hasn't happened since Mao, and that is a cult of personality around Xi Jinping. And now, I don't have the greatest insight into Chinese politics because I don't speak Chinese. So the things that I'm reading or translated, either they're translated on a free basis or I'm paying someone to translate them, but they're not. I'm probably not getting the best information out there. But the policy was really used to reinforce the power of the central government there. So now a lot of things going on in the world. I actually didn't mean to get to Tesla and EVs until a little bit later, but I just wanted to address what's going on with Xbox. So Cisco WebEx, your really the inability to deliver more than 5,100 cars, and they do deliveries, not production. It has a lot to do with another COVID lockdown that occurred, but I don't expect them to get much. The maximum they could produce, period, by the end of April or so, when their next factory is going to be completed, would be about 20,000 vehicles per month. I'm sorry, until April at least. That's the maximum they could do. They're actually going to have more problems in the way of getting the high-end semiconductors that they need. Remember, semiconductors go in just about everything today. If Russia is looting, semiconductors from washing machines and stoves in order to build precision weapons, they're in just about everything that we use today. Xpeng, because of the relatively, and Neo as well, because of the relatively small amount of vehicles that they produce and can produce based on how they've built out their infrastructure, they're actually going to face problems acquiring these chips over, say, Tesla, who by economy of scale, it's going to be much more profitable for the companies that can acquire these chips to deal with Tesla or BYD. These companies are producing 70, 80,000 electric vehicles a month. So whereas Xpeng and Neo are only 5 and 10,000 vehicles per month. So this article was pretty interesting where it named Xpeng and Neo the direct competitors of Tesla, and it just didn't mention BYD at all, which stuns me. Electrek in particular seems to have something against BYD. They just don't cover them at all. And BYD is actually the better selling best selling rather Chinese electric vehicle producer that's out there today. So didn't want to take a quick look at market stat. I didn't actually look at them as they closed, but the S&P was down 1.2%, 45. The NASDAQ was down 2%. And the Dow Jones was down 0.5%, 163. So all in all, not a day that the market moved anywhere out of the ordinary. The VIX here is at 25. Also, that's something to take a look at. Yeah. So energy up today, 1.65. Industrials leading, materials and utilities. Everything else was down. Surprised that real estate wasn't down further. But look, year to date, when we look at this chart, every single sector outside of energy is down. Okay. Energy is up not because of oil prices, but because of tremendous profits from oil companies. Look for that to continue for a while. And there's talk of a windfall tax on oil companies. Now, I would say there's a non-zero percent chance of that happening, but it's not much higher than zero, right? The United States, Congress does not have a history of imposing punitive taxes on companies simply for making a profit, right? Even when it appears, if you look at the price of oil today versus what it was in 2008 when oil briefly hit $147 a barrel, ostensibly the price of gasoline should be a lot lower at the pump than it is today. And companies really are gouging us at the pumps here. But there's a couple of different factors going on there. Back in 2008, every oil company and their mother was pouring money into CapEx trying to expand production just as quickly as they can. This time around, they're not doing that. They are maintaining capital discipline because they know that demand is going to decline at some point. Right. In 2008, 2009, a lot of oil companies, especially a lot of oil companies that I had worked for in the past, that I had invested in the past, or that I had done business with in the past, they are now gone because they mismanaged their CapEx or the money that they were spending investing in new production right before there was a crash in demand. This time around, the oil companies have focused on returning shareholder equity while the times are good, meaning that they're doing share buybacks and they're increasing dividends, which is going to give them a little bit of flexibility if we see a decrease in demand to perhaps no company likes to lower dividends, but they will be able to go out there and do an offering of treasury shares or something like that in order to raise cash to expand production when they need to, or to invest in whatever they need to. So I think that's one of the reasons that prices are higher. Will Congress go out and impose this windfall tax? Like I said, it's not a 0% chance. It is a non-0% chance of likelihood, but it's pretty close to zero at this point. Congress does not seem to be on board with this. This just seems to be a talking point, possibly because of what's going on next week, which is Sheila Joe says, if Russia's economy it goes into free fall, would this stop the war in Ukraine? I think that it really, I don't really know. It's hard for me to gauge how much. So the last time I was in Russia was more than 20 years ago. And it hadn't been kind of closed off then. I will say one thing. It is an incredibly racist place. I was treated abominably in Russia at the time. But it was also at the time when Russia was having problems with the Caucasus republics. And I don't think I look like one of the people from the Caucasus, but I was asked a lot of time if I was Tajik or if I was from Dagestan, which I don't think I look Dagestani at all. But people that were but the society there had access to the internet then, and they had access to Western media. And I was surprised at how well educated just like average people I met in restaurants or in bars were, and how willing they were to have a discussion on world events. And back then, at least, they had the advantage over me in a couple of different dimensions. They knew more about a lot about what the United States was doing overseas than I did to a degree. So I always respected the people that I met in Russia because of that, and for a variety of different and for other reasons too. But the propensity for them to just go along with whatever their government is saying, you have to say that at this point, after a couple centuries of imperial rule, and Russia having their own secret police long before there was a KGB to enforce imperial rule, then going through the Soviet Union, Soviet times, and all this, there may have actually been a sort of selective pressure on the Russian people to accept whatever authority says, meaning that if Russian economy goes into free fall, it may not matter unless this continues for a very, very long time and their economy is actually crippled. I mean, look what happened to Russia during World War II. They were caught completely flat footed. Their industrial base west of the Ural Mountains was completely destroyed. They had to move what was left of their industrial base over the Ural Mountains so the Germans couldn't bomb it. And still by 1941, less than a year and a half after the Germans broke the agreement that divided Poland with them, the back of the German army was broken at Stalingrad, and at that point, the war was basically over. It just took 4 more years to mop up the Germans, and by the end of that war, the Russian economy, which wasn't completely, siloed off, like the United States was supplying them with a lot of military equipment and money and food at that time, through not through Lend Lease. I forgot what the program was that we used with Russia or with the Soviet Union rather. They weren't completely siloed off, but they were doing really well all on their own through their own demand, and it really sort of stimulated their economy for a long time. That, I mean, generationally stimulated their economy and created a modern and industrialized Russia, right? So I wouldn't count them out completely. And especially it looks like the mobilization we're looking at probably goes a lot deeper than a 300,000 number. And are they putting their economy on war footing right now? That would be something very different as well. So that's pretty long analysis into that. But this is actually something I've been thinking about for weeks now. Is that I don't believe that the Russian economy is actually in any worse condition than it was just prior to World War II. Just prior to World War II, the Russian economy was actually just hosed. And in fact, there many areas were just coming out of a largely human-induced famine in the Ukraine and in parts of Russia as well. Yeah, but I do think the situation is much more complex than that. I think that I do agree with a professor named Michael Clark over in the UK, who has basically stated that we're probably going to see a ceasefire from this war in a year and a half or so, a year to a year and a half. It's going to be a tenuous ceasefire that leads to a third war because we're already in the second Ukraine war. There'll be another ceasefire after that, which probably leads to a fourth conflict. And at some point, it becomes a generational conflict. You have a class of people that run Russia that don't think that Ukraine has a right to exist, and an entire country that believes that they have a right to exist. And until one group of those people dies off, this conflict isn't over. I think that until the people in Russia who don't believe that Ukraine has a right to exist basically are replaced or die of old age, I don't think that this conflict really ends. We're going to have frozen conflict, and then it gets hot, and then it's a frozen conflict again, and then it gets hot. So, and I think this is just the way of the world going forward to a degree, and it's actually not going to result in good things for Russia. It really isn't. So, oh, tell 6699, thank you so much for the super sticker. And hold on a second here. Uh, okay. So, what were the lagging indicators? An important piece for the Fed to bring up. Yeah, it is actually. And that's the thing. It's hard. It's really hard for you to know that inflation, the rate of inflation. So the actual rate of inflation increases has been declining since February. And it's something called the R squared of inflation. That has been declining since February. So with a few minor interruptions, right? So it was really, really hot at the beginning of the year. It started to decline in the beginning of February. We had a little bit of an interruption, I think, in June, not in June, I think in May, but it's been declining again, right? And now we're actually seeing the real rate decline, but you don't often know that until a month later, until all of this other data has been analyzed. You plug it into the giant supercomputer or whatever, and you figure out what's going on with that. So those are some of the lagging indicators that are out there. They're not. They're looking at like the PCE and PCI and a couple of other numbers that are out there. And there's one piece of that puzzle that's a real lagging indicator that's going to take a while to figure out, and that's rents. And I think in the PCE, rents account for 35% of the calculation that they're using there. So I think we're in for elevated interest rates for a very long time. And I don't necessarily think that that even if inflation goes back to 2%, if the economy is relatively healthy and we have growth at around 2% and inflation around 2%, I think that interest rates stay where they are. That is growth with reasonable Fed policy, right? What we had before was growth with a loose money policy that couldn't be sustained forever. With interest rates at around 5%, it actually sucks a lot of interest out of the stock market for older people who are living on fixed income. If we have inflation at 2%, taxes at say 40% of that number for retired people, they're basically in real dollars are making about 1% annually on a CD or something like that. You will see that those people are not interested in the stock market. That is just one of the things that's really common with folks that are over 65 or so. If they can get a 5% CD, it doesn't matter if they can get 15% in the stock market, they're going to go with the 5% CD because it's safe. Even if you tell them, hey, you're losing, two out of that five, two out of that five is going to go away to inflation, right? Another two out of that five is going to go away to taxes. It leaves you a single percent in terms of real gain. Doesn't matter. Math doesn't matter. They still want to have that CD because of its perceived safety. So, I think that's kind of where the Fed eventually would like to be. Is it a place where you have 4 or 5%, 1 to 2 year CD rates to suck some of the interest out of those assets or out of the stock market, to have inflation at about 2%, and to have unemployment claims somewhere just north of $350,000 or 350,000 per week. So under 350,000 means that labor markets are still adding jobs or so. And so we want unemployment claims to be somewhere a little bit north of 350,000 a week. So that's let me see here. I'm getting so many like fake messages, guys, with people advertising girl services or whatever, that it's hard to find the real one. So let me see here. Phoenix says, Word Jay, I feel like a Fed spoke softish with next rate decreasing, a market bounce up. But what they said wasn't new. I felt, yet it dumped. What spooked the market is the not paying attention to what the freaking Fed says. What the Fed says is not different than what they publish in the beige book every quarter. Is that every quarter or every month? I can't remember. But just look up Fed beige book. You can find that out there. It's an incredibly boring and dry read, but it is exactly what the Fed thinks. And it is exactly and they usually indicate exactly what they're going to do. And none of that was different. Like they said, they're going to evaluate data. If you're evaluating data and making your decisions on data, it means that you're going to be looking at trailing indicators where all of the data you're getting is at least a month old, maybe a quarter old. You're making decisions based on that. You're going to see in real terms, you're probably going to witness inflation decreasing for a while before you actually see action taken by the Fed in terms of pivoting or leveling out or something like that. And they're not afraid they don't want to make a recession a self-fulfilling prophecy by saying, hey, we're trying to engineer a recession here, but they're definitely not afraid of it. Causing a recession has been the default way to manage high inflation since 1982. since Paul Volcker proved the theory, because before that it was merely theoretical, proved that that was one of the things you could do. I will say that you guys, there's a guy on, he's a professor called, I think it's Peter Zahn or something like that. He's a doom and gloom guy. Everything that he says is doom and gloom. Kind of the same with Ray Dalio, but he and Ray Dalio are on opposite ends of the spectrum when it comes to China. And I'm definitely on the opposite end of the spectrum when it comes to China. It comes to Ray Dalio, because Ray Dalio is not factored in the enormous factor of population decline in China. In the next 80 years, we're going to see the population of China be cut in half just due to natural causes. It's not going to take a war. It's not going to take a famine. It's not going to take a pandemic. They're just going to get old and die, right? And how do you manage that? You're looking at Japan, which saw the first rumblings of a population wasn't growing in about 1990, and that immediately started causing problems with their economy. And now since 2008, 2009, we're seeing the population actually decline. I think it only declined by about 20,000 people in 2008. Last year, it declined by 660,000. Okay. You had a little bit of excess mortality due to COVID, but it was just a little bit. The rest of it was due to people just dying because their population is old. Their economy has never been able to break 3% growth again since 1991, I think. Somebody correct me if I'm wrong, but I don't think it's broken 3% GDP growth since 1991, and they've been happy with 2% growth for a long time, 1% growth for a long time. Interest rates at their banks, they've done everything they can to stimulate demand with loose credit policies, with rock bottom interest rates, and they just can't get people to spend the money to support their economy. They're in desperate need of immigration, right? That is the one thing they're absolutely not willing to do. Japan is not willing to allow a ton of immigration. Now, China and the way that Japan dealt with this in terms of the economy is by pretty rapidly working their way up the value chain in terms of manufacturing. They went from manufacturing cheap plastic crap to high-end vehicle. Even the first vehicles they produced were not good vehicles. They just had really good customer service. They didn't have good vehicles till the 1990s, but no one really noticed until about the early 2000s. Kind of like with what's going on in South Korea. They had really good vehicles probably around the year 2000, but nobody really knows till about 2010, 2011, or they just weren't convinced until that time period. Japan was the same way. It was just a little bit before that. And it's not just that in terms of their electronics. Like I'm old enough to remember when anything that came from Japan was crap. And by the time I was a teenager, everything that came with Japan was top notch in terms of its quality because they worked their way up that value chain. China is desperately trying to do that now. The problem is, I think they're probably too late because they waited too late in the game to do this, and their population is just declining so quickly. So, and when you look at how much debt they have relative to the size of their economy, and there's actually a pretty good case to make that their economy is significantly smaller than we think it is, especially, and there was a very good study that was done looking at artificial light and GDP growth. And they made a comparison to see if autocratic rulers versus democratic governments, how they presented GDP numbers, and was there a correlation with illumination of cities at nighttime. And what they found was that autocratic rulers were probably overstating GDP growth by a small percentage. Like, so GDP growth in China has averaged maybe 6.5% according to official numbers over the last like 20 years or so. A couple of folks seem to suggest a couple of, and I'm not sure how reliable this data is, but a couple of different research papers that I read seem to state that GDP growth is really about 4.5% over that time period. But what does this mean in terms of what their overall economy is worth? When you go back 30 years and you start plugging in numbers like 4.5% instead of 6.5%, you're looking at an economy that's almost 60% smaller than we think it might be. So we don't actually know how large the Chinese economy is, but we do know that their population is shrinking more rapid than any other country in history outside of places that Tamerlane or Genghis Khan invaded. And we also know that labor costs are rising higher than any other period in history at all, that at least on record. So these are all problems and questions when you put them all together that no one's ever had to deal with before. and there's not a guarantee that a society is going to make those right kinds of choices. So, and Anwar, that was way off or where we were talking about. But no, I think that some people who were thinking that the Fed was going to pivot, say, hey, we're going to raise interest rates this time around, but we're not going to do it next time around. They just weren't paying attention. No one in the Fed has been talking about that at all. Zero people have been talking about that at all at the Fed. And I think that the number of people were disappointed when Jay Powell came out and said, hey, it's premature to talk about a pivot, and possibly there's a slowdown in December for raising interest rates. I think that's great. I think that is incredibly positive news. But there are a lot of people in the market who, people in charge of really large portfolios and fixed income trading houses, they've never experienced a market like this. They're just not old enough. So let me see here. Final question. I know I asked too many questions. Surely with the reliance on energy for others, this will accelerate solar and all other sustainable energy locally, more solar plants. I agree. I don't know what it's like where you live, but in the central parts of the country in eastern parts of the country where you can do solar, people have been convinced there that they can't. And there's also no government support for it as well. There's not a lot of tax incentives for it. And it's more expensive because there's a lack of competition. So I have a rental property in Texas that I wanted to put solar on. And it would have been roughly 2.5 times what it cost me to put it on my house here in California. Now I use less energy here in California, but even when I factored in the additional panels that I would need to use there, it was roughly 2.5 the times. And the reason is there was only one other company in town that was doing solar installation. And so there was no competition. And they didn't have any reason to lower prices. And I couldn't get it done for the price that I wanted to get it done for. Like I basically want to spend about $20,000 on that, make it more attractive as a rental property, and replace the AC unit I had with one that was like highly efficient. But unfortunately, the numbers didn't pencil out when I realized that my installation costs were going to be so much higher there. That's kind of the case through large parts of the country. So I think you're going to see some parts of the country like Arizona, California, Nevada, New Mexico really kind of take off when it comes to sustainable energy, and even Texas to a degree. I think already 24 to 26% of the energy generated in Texas is actually sustainable. It's either wind or solar, and that oddly enough, wind and solar was blamed for their electricity grid problems when they had that huge winter problem where everything froze. But the same thing didn't happen to El Paso, which is not on the Texas grid; it's on the national grid. The same thing doesn't happen to, solar operations in Idaho or South Dakota or the South freaking Pole. It only happens in Texas. Right? It's the only time that it doesn't work in bad weather, right? But no, I think we're going to see an acceleration of this, largely because it reduces that geopolitical uncertainty. This is one of the things that we've always known, but wars in the Middle East have always caused an interruption in energy supplies, and war in Europe can cause an interruption in energy supplies. It's really hard to do that if you're producing all of your own energy locally with sustainable energy. And it actually reduces the need to go to war if everyone's able to produce their own energy, right? Or if you're able to buy from a huge variety of people who have excess energy in the form of sunlight. Like I could see places like Morocco that has very little oil but a lot of sunshine, eventually being an exporter of energy through underwater cables or something, transporting energy in one form or another to Spain or something like that. So I see that's greatly that everyone developing their own local energy sources reduces the potential for conflict. I really do. So my number one energy stock for the near term would be Cheniere Energy, and that would be LNG. I think they're set up for a multi-year boom. So all markets are local in real estate. In energy, in oil, all markets are international. But in in liquid in natural gas, all markets are still local, largely because of how it's transported. But we're seeing a huge boom in liquid natural gas resources right now being developed, and we're probably never going to see countries like Lithuania, Latvia, Estonia, Poland, Romania, Moldova. They're probably never going back to using Russian oil once they wean themselves off. And I think that liquid natural gas transport, I think there could be some shipping companies that really benefit from this. And I think there could be some of course, some liquid natural gas companies, but all of the major oil companies as well. They're all up to their elbows in liquid natural gas and that sort of thing as well. So I would say that energy on a long term basis, you want to be looking at companies that have diversified energy. The heavier they are invested in simply oil, I think the worse they're going to fare in the future. Natural gas stays around for a while, even with it was something like 39% of electricity generation in the United States comes from natural gas, and only 1% comes from actually burning oil. So yeah, let me see here. So what's the outlook for oil prices? Price of diesel has gone up 10 cent or 10 pence a liter in the last few weeks. So the price of diesel has gone up here too in the US. In fact, it was a political talking point for one of the parties, basically panicking and saying that we only have 26 days of oil supply left in the United States. And I don't know if they're really that stupid or if they're just comfortable with lying. So we always have less than a 32-day supply of diesel in the United States, and we're always producing millions of barrels of diesel a day. And the reserve supply that we have of diesel vacillates between 24 and 32 days all the time. None of this was out of the ordinary. I saw this all over right-wing media where they talked about the 20s, and especially on that on Tucker Carlson, when they talked about the 26-day diesel supply. I'm pretty sure that he knows he's lying and he just doesn't care. But if not, he's abysmally uninformed when it comes to the oil and gas industry. We don't keep around years of oil supply in the US. We don't keep around years of gasoline supply. We don't keep around years of diesel supply. We are constantly producing it. Sometimes we have a shortage. We don't have a shortage, but sometimes that gets down to 24, 25 days or so. Sometimes it gets as high as about 32 days of supply, and that's it. That's the range that it's in. And a lot of these concerns, like I said, are brought up by people who either know better or don't know better because they just don't know. So let's see here. You can watch the government shift strategy soon and aim for a peace deal. Yeah, I'm not sure that that's going to happen. And I'm not sure that's going to happen. I think that Ukraine in particular doesn't want a peace deal. I think that Russia is searching for any off ramp that they can. But Ukraine does not want a peace deal. What they want is a return to 2014 borders. And to be honest with you, the fact that the United States did not react in 2014 to Russia seizing Crimea, meaning that we didn't react forcefully to that, is the reason that this happened today. We signed a security guarantee with Ukraine, and we should have honored that security guarantee. And I think it's fairly obvious when you look at the level of resistance of places like Kharkiv, which are Russian speaking, and a majority of Russian speaking people who do not want to be a part of Russia and who resisted heroically. I don't think that we should pay any attention to the fact that there are more Russian speakers living in those areas and say they should go to Russia. We should let those people decide for themselves in a free and fair election or something like that. I don't know. But these borders have been recognized since 1991. The United States doesn't have the right to change borders unilaterally, and neither does Russia. So yeah. When the oligarchs run out of money, Putin for me will be gone. I suppose, but I don't know how long it's going to take oligarchs to run out of money, and I don't know in an enclosed economy like they are, like they're going to be really soon. Money is not going to matter as much as the ability to project power. So yeah, and you see any good U.S. semiconductor manufacturing favorites to hold until 2030. Honestly, all of US semiconductor manufacturers are going to be best bets to hold until 2030. So TSMC is making a case that the U.S. efforts to stimulate a semiconductor manufacturing base in the U.S. are going to fail. They're trying to make that case right now, and I think a lot of that has to do with they're building a giant factory in Arizona, and they want to take all of that business. But I think that the giant factory that they're building in Arizona is really a risk mitigation strategy on their part. If the unlikely event that China were to take over Taiwan happens, then the United States would probably continue to allow TSMC to operate out of that plant in Arizona, and it would and continue to, yeah, they would probably continue to allow that to happen. But I think that there's probably going to be a long term boom in semiconductor manufacturing here in the U.S. So TSMC is a Taiwan-based company, but they're pouring a lot of money here in the U.S. Micron is going to spend something like 50. Wait, no, was it 50 billion or 150 billion? They announced something north of $50 billion in investment here in the United States. NVIDIA is looking to do the same. Intel is looking to do the same. AMD is looking to do the same. Honestly, I might go a little bit more conservative with that and go with like Micron, AMD, and Intel rather than with NVIDIA. So I do own quite a bit of NVIDIA, but it's really super volatile. And I do think they're going to do very, very well. But if you just wanted to be in that semiconductor space, I think Micron might be a good way to bet. And that's not a company that I was enormously hot on just a couple of years ago. It isn't. So, yeah, let me see here. Shoeless Joe, thank you so much. Hey, I'm getting a lot of like foreign currency today. I'm happy about that. Getting some euros, getting some pound sterling, getting some Canadian dollars. Thank you also, Vane H. And yeah, that is one share of SoFi, which I bought like 100 shares of SoFi today. Will we be seeing double-digit mortgage rates next year? I don't think that's likely. I think that we may see mortgage rates top out at just under 8% by next year. I doubt we'll see double-digit mortgage rates, and for a couple of different reasons. I think that in the event that the Federal Reserve actually slows down the rate that they're raising interest rates, they're probably going to speed up the rate at which they are selling bonds that they have in on their balance sheet right now, which will have a similar effect to raising interest rates, which will actually cause an increase in yields long term, as it's going to drop the price of the long term bonds that they're selling. Uh, I will say that they're probably going to sell their longer term bonds first. The average duration of the debt that the Federal Reserve has on their balance sheets is only 5 years, right? So it's actually shorter term. Duration is a more complex calculation than just saying the average maturity. So maturity could be 10 years. Duration is kind of like when the bond reaches what it's worth. I'll go over what duration is in a separate video because it does require a separate video. But let's just say that the obligation, the outsized obligation on those bonds only lasts on average for about 5 years, right? And so I don't see that we're going to see double-digit mortgage rates like next year. I think they'll settle somewhere less than 8%, and then they'll start to decline. And I think they won't be much higher. What's really going to be unsettling for stock market investors is when short-term bond rates and CD rates really stick at around 4%. And that's going to be trouble. It's going to suck a lot of older people out of the market. They love CDs and fixed income, man. That's the way it goes. We see. It would be really interesting to see how global relations change as we reduce reliance on oil and increase reliance on alternative energy. I think so. Also, there's a lot of people that we are allies with that I'd rather not be allies with. They just happen to have oils. I have oil. There's a lot of folks that are extremely rich because they control that oil, and we Western folks sort of installed them in power and keep them in power because, hey, the devil is better than the one you don't, right? I do think that none of this happens without massive social upheaval or without these autocratic countries now investing pretty liberally into their population to sort of buy their loyalty. So I see this as an interesting century coming up. And, One of the weird things is I've always prepared my kids for life to be more difficult than it was for me. And I think that my life and making it in some degrees has been more difficult than it was for my parents, especially in terms of acquiring net worth. And I think that people just 10 years younger than I am have a much harder time of doing that because of the economic crises that they've had to face. And I'm not preparing my kids for things to be better. I'm preparing them for kids to be worse. If I'm wrong, they're really well off. If I'm right about everything, they survive and perhaps thrive as well. We see here. X-Links Morocco UT power project. See, I didn't know that there was one going on right now. I just kind of figured there had to be one. Morocco is a country that I spent quite a bit of time in, and but they're sending solar and wind from Morocco to the UK via cable. Didn't know that was happening, but I'm glad to hear that it is. Not surprised at all. George Shuda says 3 FANG stocks: Facebook, Amazon, and Google basically have the same price per share. Means nothing. However, PEs and department favors Google over Amazon. As for Meta, I simply don't think. Yeah, I had this discussion about Meta with someone on a live stream. I don't think. I think the Metaverse is going to be a thing. I just don't think it's going to be a thing that is developed by Meta. I think that it is going to be. I think they're going to get out innovated and replaced by someone else. So I no longer have an investment in Meta. It wasn't a short-term decision for me. I took a look at when I started getting interested in the metaverse, and it wasn't me that initially got me interested in metaverse. It was somebody in my Patreon group who helped me write that video for that. And even when we did that video, we listed Facebook as one of the big providers of metaverse technology, but I didn't highlight them in any way, largely because already then I didn't feel like they were going to have a way to do that. They can create a metaverse. I don't think they're going to find a way to monetize that metaverse. And the metaverse, the way we're envisioning it, where it's just a virtual world where you play games, you interact, you socialize, whatever. I think there's not going to be one metaverse, but the one that becomes dominant is the one that figures out how to monetize it in a way that's seamless, in a way that you don't feel like you're being ripped off all the time. Think about how like in-game play work to generate for games rather than downloading it off the internet or getting it up from a CD and selling you an update and all that, how in-game play kind of worked to improve the bottom lines of all of these companies. Same thing is kind of going to happen with a metaverse at some point. Now, augmented reality is a different story. I think that the great success of that is actually going to come in industry of some sort, probably in manufacturing, where it's going to be used as a manufacturing aid. I'm going to be doing a video on that one of these days. I kind of did a partial one. So let me see here. Are you currently in any lithium stocks? The only lithium stock I own is actually Albemarle at this point, and then I own LIT, which is the lithium ion battery chain ETF, which there's some duplication in there because I think the largest holding in LIT is actually Albemarle, but that's the only one that I hold. I would be very careful about investing in lithium, really small lithium companies. It's a lot like investing in wildcatters for oil. Like even really experienced people screw up a lot. That's why you don't see like a single oil exploration company that is usually very large. The oil exploration company is usually a holding company. And what they do is they go out and they buy these smaller players because a lot of these wildcatters are going to screw up the drilling process. They're not going to find oil. Or they're going to find oil that's too expensive or too deep or just too expensive to get out of the ground. Or worse, they're going to hit gas. And I realize it's kind of funny now, but that actually used to be the thing. They'd be like, "Hey, did you find oil? No. Did you not find any oil there?" And the old wildcatters would go, "No, worse. Not only did we not find oil, we found gas." It used to be a terrible thing to find gas because it was hard to handle and hard to manage, and it didn't have as much economic value. That's all changed now. But yeah, so I would be very careful though, because a lot of these lithium mining stocks, they're really going to be set up like wildcatters where people dump in money into these companies. They tell you all about the deposits they have or the mineral rights that they have, but these companies are really set up to limit liability. So if the find is really good, then they're probably going to sell out to one of the larger lithium miners because it just makes sense rather than developing yourself, walk away with a couple $1 billion. But a lot of times their techniques, or what they find is just not going to be as good as what they thought. And the company would actually fail. And the reason it was set up like that, like a really small company, is to limit liability. These guys have probably 10, 15 different companies that are set up out there to do this. And one holding company holds them. And because of the nature of corporate ownership, that liability is not going to flow upwards from those companies. The liability is limited to that level, right? So be very careful about investing in lithium stocks. And I think actually that would be very difficult unless you are in the lithium mining industry or you're a geologist or a chemist. I think it'd be really difficult for you as a layman to evaluate whether or not this is a good lithium stock. You're probably better off owning a basket of lithium mining stocks or a large part of the lithium ion battery chain, or just owning Albemarle, which produces most of the world or most of the United States, or the lithium for the United States, all these precursor chemicals for batteries and everything. So let me see here. I got a question about, let me see. Warner Bros. Discovery. Oh, what about WBD? I bought 800 shares, and Majid says I bought 800 shares, and now it's eating my money. Yeah, I'm surprised that it is, and I'll tell you why. So Warner Brothers, it takes a while on my internet connection because it's slow here. I don't know why. I don't know if it's because I live so close to the well, that's probably why. So for the last 3 years, 2018 or 19, 20, 21, we've seen declining earnings. We've seen 4 quarters in a row of missed earnings, right? So price to earnings ratio, and this could be a prime example of what's called a value trap, where things look like a really good value, but over time you see why it looked like a really good value. So we've had 3 years of declining earnings, and in the last 4 quarters we've had 3 or 4 quarters of decline of earnings misses as well, and their earnings are declining. But earnings per share is $1.81. Price to earnings ratio is 6.61, and beta is at 1.38, which kind of doesn't match with the low price to earnings ratio. Volume is very healthy, but when we look at the history of the stock, right? Let's just look at the last 5 years or so. Look at the history of the stock here over the last 5 years. Since 2020, it's declined from 50 all the way down to $11 a share. So it declined from the middle of the pandemic all the way down to its current price in an era where we saw a huge boom for streaming services and entertainment. And why did it do that, right? So I don't know enough about this business. I don't follow this business, but I would say that this possibly represents one of the clearest examples of a value trap. It looked like a really good value based on its price to earnings ratio, but there was a good reason for its price to earnings ratio to really have contracted like that, because there was either a reason to believe that their earnings were going to contract more, or it's because their earnings have already contracted quite a bit and the market has priced that in. I think that the second case is true, that earnings have already contracted quite a bit and the market has priced that in. What I would want to know is what is, and it says Warner Brothers Discovery, a company of yesteryear trying to be the company of tomorrow. My thing is, what are they doing to, like with Netflix, you can always kind of look at their pipeline and see what's coming down in the future and what may result in larger revenues. Like I kind of at the beginning of the year said, oh, well, Netflix got crushed and things aren't going to get better until fall, because that's when part of their new lineup starts coming out. They were just reaching kind of a dead spot in the amount of like new material that they had coming out, and they have increased competition. It means that during that dead spot, they're going to get crushed, right? And because now we're seeing greater flows in membership between streaming services, and we're seeing, ad tiers and all that stuff pop out, but we're seeing this addition of new materials that are coming out, and over the winter you're probably going to see a huge bump up in Netflix memberships, and that has a lot to do with with some of the new series that are coming out. So yeah, I would say that Warner Brothers is one of the best examples of value traps that I've looked at in a while. So Vane H says, hear you on smaller lithium players, but deals are big, and SGML is a big new player. Jay, we're testing SP 536 soon. You think Yeah, I think that we're going to see a move back to around 3,600 at some point. It just looks like this cycle of earnings was nowhere near as bad as people thought it was. The what the Federal Reserve said about interest rates and what they've predicted is going to happen is pretty much exactly what the market expects. Not a surprise in the positive, not a surprise in the negative. And I think in the absence of any real positive catalysts, we're probably going to see an erosion of market value back down to that 3,600 level. But I think a real bottom formed at around 3,600. And my reasoning behind that, and it was literally the day I said it. I came on. It was actually on my birthday. I came on that day, and I was like, "Hey, this is the market bottom. Bottom is formed." And the reason I said that is not due to a ton of like data, which I really like. It was due to one piece of data, and that was the breadth of the rally. The rally occurred on that day in virtually every sector across every single market cap. And like I said, and it basically in every asset. And that's when I thought that's just the bottom. That's the point where there's no more sellers left, right? So that's also again where we reach the point where there's no more sellers left, because we have a lot of people now who jumped in the market when the S&P was at 3660, and I think at 3660 is where we see another bottom form. We probably see a massive sell off then, and that's kind of where that next bottom forms. And then I honestly think that may be the last one, even if interest rates continue to rise. Markets rise even when interest rates rise. Business continues to be done even when interest rates rise. We are possibly going to see a mild recession next year. I don't think it's going to be this deep, long recession. We just have tons of liquidity in the system that has to be dried up before we get back to that 2% inflation level. But I think that also leaves us a lot of room for the business cycle to recover as well. So you see, V8, the supply agreement starts until 2026, and there are a number of suppliers coming along 24, 25. It's a long time to tie up your money. 2 years is not a long, or 4 years is not a long time to tie up money, Michael. So I've had Tesla stock since like 2011. Not a long time to. I've had Monster Energy. Well, what little Monster Energy I have, I've had since 1998 when it was Hanson Natural Products, and I sold off a lot to buy my house. But otherwise, I would still have it. It's not a long time to tie up money if you think that there's growth coming on. So I just bought a bunch of Money Lion, for example. And what I like is growth trends in the platform. What I like about the industry is so wild and so open that as long as you can grab some initial market share and get to profitability, you'll probably keep growing for a decade or more before we start to see a reconsolidation in that fintech space. There's just so much dissatisfaction with people and financial services, and it's become so much easier to switch financial services that I think that really small players are really going to benefit for this over the next decade or so, as more and more business gets sucked away from the big boys. It doesn't really matter that the big boys can offer you everything and more that these smaller guys can. You don't use all of those services. You only use some of them. You only use the ones that you need. And the large companies are never going to treat you like the individual. Wow. First financial planning question that I've gotten on this in a long time. So my son actually just asked me to help him open up a trading account for him. A couple of different ways to do that. Since he doesn't have any income himself, what I could do is hire him on to one of my companies and kind of pay him an income and then make him do a job. Little guy needs to do some jobs anyway, but he wants to trade his own stocks. So what I'll probably end up doing for him is a UTMA or a UGMA account. I forget which one in California. I think it's UTMA account here, which is a Universal Trust for Minors account. So the great thing about that is, it legally becomes his at 18. You can maintain control of it though until he's 21 or so, with a few caveats that we could go over in a private conversation at some point. But the problem with that is it's going to be taxed at your bracket. The gains are going to be taxed. Short-term capital gains are going to be taxed at your bracket, and any income in that portfolio is going to be taxed at your bracket, which could be a lot higher. I think the first like $600 or $800 of gains is taxed at the child's bracket, and the rest of it is taxed as yours. So if you're willing to assume that tax burden on that additional investment, then it's a good way to go. But if your child has any earned income at all, they can make a contribution, or you can make a contribution on their behalf to a Roth IRA. And that's one of the things you may want to consider doing as well. And I think that's a better way of doing that, because then they're able to buy and sell inside of that to their heart's content while they're under 18 years of age. And after 18 years of age, you should have a talk with them about, hey, this is what responsible investing looks like, responsible long-term investing looks like. And it's a good way to help train them. But I'll tell you what I got started with first is I got my kids started on Investopedia, where we did like a little investing game. And you can compete against other members of your family or other friends or whatever in terms of investments. And they had a lot of fun doing that. And that is what got my son interested in investing. And I'm really happy about that. Man, the kid just likes money too. Like, he takes things to school and sells them all the time. Like, he buys pencils and I don't know, all kinds of stuff from Japan when he goes to Japan in the summer, brings it back to the US and sells it here. He'll even sell part of his lunch at school in order to make some money. So he's making a little bit of his own money by selling Legos and selling pencils and things like that. Now he wants to start investing that. And I think what I'll end up doing is whatever he puts in the account, I'll match, and I'll help him get started. But I may end up doing with him those, like employing him with one of my companies, giving him a little bit of an earned income so we can just make those contributions into a Roth IRA. But anyway, folks, I got a jet today. I've been on for an hour and 5 minutes. Once again, always nice to talk to you. Thanks very much. Tell 666-999, Vane H, and Shula's Joe for the super chat contributions. And I will see you guys. Today is Thursday. I will definitely see you guys on Monday. Thank you very much, and have a nice day.